Keeping money in a bank is safe, but it may not make you wealthy. Today we'll explain saving versus investing and when to use each. Many people treat saving and investing the same, limiting financial progress. We'll break down their meanings, compare risks and rewards, and show practical choices. First, saving, security. Then, investing, growth. Next, a clear risk versus reward comparison with simple charts. Finally, when to use each approach. Visuals will include clean motion graphics, simple charts, and cinematic footage to keep ideas clear. Listen for practical tips you can use today. Tone is clean, professional, and modern. We'll keep explanations steady and friendly so you can make better financial decisions with confidence. Let's start with saving, what it is, why it matters, and how it keeps you secure before we cover investing for growth. Saving means setting money aside for safety and short-term needs. It's about preserving funds, staying liquid, and avoiding losses. Typical saving vehicles include bank accounts, money market funds, and short-term CDs. They prioritize low risk and easy access over high returns. Savings earn interest, usually low. That interest helps a bit, but often doesn't beat inflation over long periods. An emergency fund is core savings, 3 to 6 months of expenses kept in easy-to-reach accounts for unexpected events. Use saving for short-term goals, upcoming bills, and safety. If you might need the cash within a few years, save instead of invest. Now that saving is clear, let's move to investing, where the goal shifts from security to long-term growth. Investing means buying assets like stocks or bonds to grow wealth over time. It accepts some risk for the chance of higher returns. Common investments include stocks, bonds, mutual funds, ETFs, and real estate. Each has different return prospects and volatility levels. Compound returns make investing powerful. Reinvested gains earn their own gains, accelerating growth over years and decades. Investing involves volatility. Prices go up and down. A longer time horizon smooths short-term swings and increases the chance of positive returns. Historically, stocks have offered higher average returns than savings, but with more variability. Bonds sit in between, balancing risk and yield. Diversification, regular contributions, and a long-term plan reduce risk. Investing is a marathon, not a sprint. Now we'll look at simple charts comparing saving and investing, timeline, return curves, and risk bands to visualize differences. A line chart shows savings growing slowly and steadily, while an investment line rises faster but wiggles up and down. Inflation erodes uninvested savings over time. If returns don't keep up, buying power falls even as the account balance grows. Example, $10,000 saved at low interest may feel safe, but invested with reasonable returns, it can multiply significantly over decades. Higher potential returns come with higher risk. Decide based on goal timing, tolerance for ups and downs, and financial needs. Use a simple rule. Short-term and safety needs call for saving. Long-term goals with time to recover call for investing. If you need money in under 3 years, saving is usually best. Preserve capital and keep funds accessible. For 3 to 10 years, consider a mix. Conservative investments or higher yield savings can balance growth and risk. For goals beyond 10 years, investing typically fits better. The market's growth potential compounds wealth over decades. Your age, income stability, emergency fund size, and comfort with volatility determine the right mix of saving and investing. A practical path. Build an emergency fund, pay down high-interest debt, then allocate ongoing savings to diversified investments aligned with goals. For choices tailored to your situation, consult a qualified financial advisor. Take these principles, build a plan, and let time work for you.